Hello, hello, I'm Marinade. This is Boom Bust, and these are some of the stories that we're tracking for you today. Valentine's is less than 2 days away, and in honor of this artificial holiday, we're going to be talking about gold today. Global demand for the shiny stuff hit a 4-year low, and we'll discuss coming right up. Then Marc Faber is on the show. The publisher of the Gloom, Doom, and Boom report is joining us from Hong Kong to discuss Sweden, Japan, and precious metals. And in today's Big Deal, Edward Harrison and I are joined by our very own Bianca Fascini to go over your feedback from this past week. You definitely don't want to miss a moment, and it all starts right now. Now, like I just mentioned, Valentine's Day is around the corner, so we thought it appropriate to discuss gold today. Now, as we all know, during times of turmoil, people tend to pile into safe haven assets, and many people's very favorite safe haven asset always has been and always will be gold. The precious metal is having a mixed year, however. Global demand for the global shiny stuff has hit a 4-year low. However, thanks to turmoil in the Eurozone, gold has bounced back more than 3% this year after falling 28% the previous 2 years, basically because global inflation failed to ever fully materialize. Now, according to the World Gold Council, China failed to repeat its 2013 record gold buying year. The sale of gold coins and bars halved as the overall demand in China fell 38%. India is back on top when it comes to who buys the most yellow stuff. India's 2014 gold consumption leads China's by 29 tons. India's consumer demand for gold jewelry and investment totaled 842 tons last year, compared with China's 813 tons. India and China accounted for 54% of consumer gold demand in 2014 as a whole. Now, the World Gold Council forecasts that gold demand in both India and China will rise by, or anywhere in between, 900 and 1,000 tons in 2015. But that said, India was likely to retain its edge. Europe's demand for the shiny metal is also up. This comes as worries over the fate of the euro led to an increased demand for gold bars and coins in the fourth quarter of last year. Now, as the euro weakened against the dollar, the price of gold in euros rose 14%. And as of 4 p.m. Thursday in New York, gold was trading at $12.21 an ounce. To discuss Sweden, Japan, and gold, we're joined by Marc Faber, editor and publisher of the Gloom, Doom, and Boom report and director of Marc Faber Limited. Now, Marc, just today, Sweden took perhaps the most aggressive policy move we have ever seen from a major central bank. Not only did it announce a negative interest rate, but it simultaneously launched a quantitative easing program and gave guidance that it could do more, including buying bank loans unless it produced inflation. So what in the world is going on?
Some people say there is a currency war going on, but I don't buy that argument. In my view, central banks around the world are coordinating printing money one after the other. It's like handing over the baton to someone else. It started with the Fed, then went to the Bank of England, then the ECB, then the Bank of Japan. Every central bank will do the same. And in my view, if the dollar, as a result of these moves overseas, becomes even stronger, the Fed will then use a strong dollar as an excuse to ease again. This is what I think is going on.
Marc, you told Barron's just last month that if I could find a way to short central banks, that is what I would do. This is the year that people will lose confidence in central banks, mostly because of the failure of Abenomics in Japan. So how can one replicate a central bank short position?
Well, I mean, my sense is that eventually most investors will lose faith in money. Say, if you have to deposit money in in a currency like the Swiss franc, and you get on 10 years bonds a negative rate of interest. In other words, for 10 years, you will lose money every year. And the money deposited is not that safe. I think a lot of people will rush and buy fixed assets, such as real estate. They'll buy gold and silver, platinum, palladium. They'll buy art. The latest art auction had a gold at over $300 million, and so forth and so on. I really feel that we are in a very bizarre and dangerous situation where the central banks are deliberately creating another colossal bubble in the world, a colossal bubble.
Now, Mark, gold has been treading water this year, and the last I saw it was just under 1,230 level per ounce. So what do you think of physical gold and paper gold, gold ETFs? What are your thoughts?
Well, I buy every month physical gold, and I own gold as part of my asset allocation. It's not that I have 100% of my money in gold, and I don't speculate in gold. These are my iron reserves. I'm not concerned about the price of gold. Maybe it goes down, maybe it goes up. If you buy Tesla, maybe it also goes down and maybe it goes up. Or if you buy Apple, maybe one day it's worthless and maybe one day it's worth much more. Who knows? The point is simply, I want to have some of my assets in gold. My concern, however, is this. The establishment, the central banks, the governments, and so forth, once faced with complete failure of their new Keynesian or neo-Keynesian economic interventions with fiscal measures, with monetary measures that have allowed global debts to still expand by $57 trillion since 2007. Once faced with these failing policies, they'll blame people who hoard gold, and they'll maybe expropriate gold. That is my concern.
And how about the gold miners? What are your thoughts there?
The gold miners are very inexpensive. So, say last year when gold rebounded by roughly 20% in the first half of the year, the gold mining indices like GDX and GDXJ went up by more than 40%. So if someone is more risk inclined, he will do better in gold miners. But there's a higher risk. It's more volatile. The gold price drops $200. The gold miners are going to get slammed. If the gold price goes up by $100, gold miners will go up by a higher percentage.
Here's the thing, though, Mark. You know, global gold demand is at a 4-year low, with demand from China off 38%. Now, that's just huge. So why is gold not responding to the signals central banks are meting out?
Well, you know, if you print money, one of the problems is that not everything goes up equally. And the central banks, essentially notably the Fed, has been printing money and creating bubbles since 1998. So we had the tech bubble, the NASDAQ bubble. Now, please tell me how many tech stocks that peaked out in March 2000 before the NASDAQ dropped 70% have made new highs? Very few. Then we had the housing bubble. Well, some housing prices in some areas are at record highs, like in the Hamptons, in Newport Beach, Park Avenue, Fifth Avenue, Madison Avenue, the high end. But most home prices are still significantly below the highs, and so forth and so on. And we had a commodities boom in 2008, when in July, the oil price went to $147. Now it's down to slightly above $50. All I want to say is the money flows not equally into the economy, and gold has done very well, like silver, since 1999. But we had this very meaningful correction post-September 2011. But look, I'm not here to recommend anyone to buy gold. I'm buying gold for the reasons I just outlined. And I have also real estate, I have stocks and bonds and cash.
That was Marc Faber, editor and publisher of the Gloom, Doom, and Boom report and director of Marc Faber Limited. Time for a very quick break, but stick around because when we return, Jim Pierce will be on the show. The CIO of Baton Investing sat down with me in studio earlier today to talk about disruptive technologies in the financial services sector. Then in today's Big Deal, Edward Harrison, Bianca Fascini, and myself are fielding your questions, comments, concerns, all sent in throughout the week live on today's show in our accrued interest segment. Plus, remember, you can see all segments featured in today's show on YouTube at youtube.com/boombustrt and on Hulu at hulu.com/boom-bust. Now, as we head to break, here are a look at some of your closing numbers of the bell. Don't go anywhere. I'm a fighter. I can take a punch. I live. I learn something every day. I strike when I need to strike.
Just like that.
I prepare. I've earned everything I have. If I fall, I get back up. I won't be underestimated. I'm Aaron Aid, and I put the boom into boom bust.
Here's what people have been saying about Redacted tonight.
Give it to us.
Redacted is full-on awesome.
Real?
The only show I go out of my way to watch every week. It really packs a punch. Lee Camp is the John Oliver of RT
You
America.
guys do have the same accent.
Hey, we are apparently better than boobs.
Nothing's better than boobs.
You see, people you've never heard of love Redacted tonight. The president of the World Bank, though, hates it.
Well, he doesn't really have any taste.
Seriously, he sent us an email.
So you visit the doctor for a routine checkup, and he tells you that you need immediate surgery. But I've been healthy my whole life, you say. No, he says, you must be feeling pain. And you say, but I don't feel any pain. Let's get you prepped, but scalpel, please. And you don't say a thing. You just take it. It's the same with news. You can just sit back and take that first opinion, or you can get a second opinion.
Welcome back to the show. Up now is my interview with Jim Pierce, CIO of Baton Investing. Now, I first asked him what's happening in financial services regarding technology in general and the internet specifically. Here's what he had to say.
Right, so just so you know, I started out as a stockbroker in 1983 before computers really even came into the space. So for me, it's really been fascinating to see the extent to which the industry's evolved. Like everything else, technology is very positive, but it's also very disruptive. And in the financial services space, what technology is doing, on the one hand, is making it more accessible, more liquid. On the other hand, it's also making it, in some ways, more difficult for investors who don't have the sophistication or the access to resources that the others, bigger investors do. So what I'm trying to do at this point in my career is work on things that bring the stock market to kind of the average guy, so to speak. There's plenty of companies out there serving the institutional and high net worth investor, and those are the folks that really are out there in the market every day. But I kind of feel like sort of the little guys being left behind in some ways. Okay. And I'd like to see us use technology in a way to really help everyone, kind of democratize the market.
So are you competing with the E-Trader of the world, those kind of more general platforms that anyone can jump on and start trading?
I wouldn't say we're competing with them. In fact, I would say that that's the means by which our clients are executing the different services we're bringing to them. We're agnostic as to E-Trade or any of the other brokers. There are a couple that work particularly well with what we do, but we have no formal relationship, no form of revenue share or anything like that. But there are certain brokerage firms out there that are using technology to make investing much more accessible.
Interesting. Now, we've seen a lot of companies like Credit Karma. That's the consumer credit space. Then you also have Real Vision, which is in the education space in terms of what people need to know in order to make put down appropriate positions. And then you have StockTwits, which is the social media space of finance, which is interesting as well. But where are the biggest opportunities for mass media marketing for finance?
Well, that's a good question, because the company I work for, Capital Information Group, we're sort of in that space. And we started out 40 years ago literally as a print shop. I mean, back in those days, we sent out, and we still do, by the way, sent out a 12-page publication in print. But, of course, the industry is now all going virtual. So the big question everyone's having is, how can you compete in that space, from a marketing perspective and earn an ROI that's worthwhile? So I believe the answer is it's going to be in strategic alliances, whereas a company like ours finds a brokerage firm or some other provider where our product complements the service they provide, rather than us basically just sending our message out in the cyberspace and hoping enough people see it and read it and act on it for us to continue to stay in business.
Right. A little more defined, kind of what you want to look for, what you want to pick up. So how much of what is driving consumer finance offerings on the internet is driven by mobile? That's a big thing, because everyone says that we're going away from PC towards more mobile. So what's the story with that? Well,
I think that's certainly true with, I'm going to say, folks under, say, 40 or 45. Now, that doesn't include me, unfortunately. I wish it did. But for someone like me, and coincidentally, my wife and I just recently bought a house. I didn't do any of that from a mobile platform. I still have my mortgage banker that I call on the phone. I still have my builder that I call. But for my kids who are now out of college and will presumably be buying their first homes in a little while, everything's on their phones and is mobile based. So I really do think over the next 10, 15 years, you will see that segment of the business really take over the majority of the business. But for now, that's still a scary world. I mean, it's one thing to put it out there.
Right.
But the thing that we hear all the time, even from the younger users, is it's overwhelming. There's all this stuff out there, and I want to go buy a house or buy a car. Yeah, all that data is there, but data is just data. Without the synthesis, without somebody interpreting it for you or combing through it and delivering it to you in a way that's actionable and easy to understand, a lot of times people start out with good intentions, they get partway through the process and then drop out.
It's true, and I like that data is just data until it's really looked at. Tell me about your company, Baton Investments. What is this firm? How does it work? I'd love to hear the ins and outs.
Right. So for me, Baton is sort of like a second childhood in this business. Like I said, I started out as a stockbroker 30 years ago. I had a great life. But a couple years ago, I just felt like it was time. As I mentioned, my kids were out of college, and I just felt like, all right, Jim, before you cross the finish line, let's try to do something new and interesting and helpful. Yeah. And at about the same time, I paired up with the Ash family over at Capital Information Group, and we talked about it and decided that where we wanted to be was in bringing stock market investing to that first-time investor, somebody in their 30s, maybe even in their 20s, if they have the money, but to deliver a stock market advisory service in a way that was inexpensive, not very time-consuming, and very actionable. In other words, easy to execute. And with Phil and Brad Ash, after several months of kind of hashing through it, we believe that Baton is the platform. In other words, it's designed to kind of look and feel and act like an app.
Okay.
Because we're so used to apps now. You want to know what the weather is? Bing. Want to know what traffic's like? Boom. So, but that's not how it is in investing. Again, in the old days, we would send people these long documents and say, here, read this, figure it out, and then go do something with it. That doesn't work anymore.
You've said, quote, 75% of investors these days are using modern portfolio theory, whether they know it or not.
Right.
And are all invested in essentially the same thing. The result is widespread mediocrity.
That's correct.
What did you mean by that? That's interesting to me.
Okay, so what I meant by that is Modern portfolio theory is something that actually was developed in the 1950s, but didn't really take hold until 1970s, 1980s. But in other words, it's an attempt to apply science to the market by looking at historical relationships between different asset classes, U.S. stocks, global stocks, government bonds, so on. And anyone who came up as a certified financial planner like I am, that's literally part of the training. So it became very popular. There's a part of modern portfolio theory referred to as the efficient frontier. And a lot of people have seen that chart where it shows the optimal trade-off between risk and reward between all these asset classes. What most people don't understand is that the efficient frontier is now used really as the device to manage asset allocation in variable annuities, target date funds. Now keep in mind, for most 401k plans, target date funds are now the default option. So you go to a new job, put money in a 401k, you say, I don't know what to do, or I don't know, you tell me what to do. You're going to end up in a target date fund, and that target date fund is the efficient frontier from modern portfolio theory. If you go to a professional investment advisor who's managing a portfolio for you, the vast majority of them, not all of them, but the vast majority of them are using some form of the efficient frontier. So what happens is this enormous amount of money is essentially all invested the same way, or according to the same set of rules. So it's not realistic to expect to outperform the market when you are the market.
That was Jim Pierce, CIO of Baton Investing. Time now for today's Big Deal. Big Deal time with the lovely Bianca Fascini and Edward Harrison. I kind of like these all at the table. It's different karma, but it feels good. And today we are going over viewer feedback, what we like to call our accrued interest. And Boom Bust producer Bianca Fascini, like I mentioned before, picked out some of the best comments from viewers this past week. So, Bianca, tell us, who said what?
All right, first comment is from YouTube. In mainstream economics, GDP is highly important. However, mainstream economics has more to do with alchemy and astrology than science. In the real world, GDP is useless by itself. Using a single number to rate a nation is highly impractical. A $500,000 home in San Diego is not the same thing as a $500,000 home in Alaska, and a $1 million home in San Francisco is not the same thing as a $1 million home in New York. Money is a good facilitator of trade, but it is a very simple indicator of complete value. GDP by itself is a useless number. The idea of GDP was created a long time ago. It was outdated back then, and it's even more outdated today.
This guy really hates GDP.
Yeah, he's not into it.
Maybe he likes that purchasing power parity a little bit more. It's something interesting to look at as well. You know what, I have to say, Marc Faber mentioned something about this in the beginning where he was like, you know, I don't know if we aired it in this segment, but I believe that we did, that he basically alluded that all of the numbers are kind of cooked. You know, however you equate for these numbers, they're not authentic. And I think that's kind of what this person is saying in a much more logistical type way, which there is a lot of truth to that. And I mean, you also, who wrote this? Machuda. Oh, good Machuda. We love Machuda. He always writes in, he or she. And you also said that it's like astrology. I wouldn't necessarily say it's like astrology, but we do know it's a soft science. It's not a hard science, you know, so there is room for interpretation. But interesting comment. Thoughts, Ed?
I would go even deeper. What he's basically saying is that GDP is a ridiculous stat. It doesn't represent the economy at all, and that basically we should either get rid of it or use a panoply of different data to represent that. You could use something like, you know, infant mortality rates, or you know, how old people get, you know, what the median income is, etc. But GDP, using that one stat, is bad. And also, what about the whole infinite paradigm growth? The infinite growth paradigm that's implicit in that. Basically, you need to grow and grow and grow all the time. I mean, there are a finite number of resources.
Well, capitalism, they would say that that's the whole thing behind it. You know, that you have to keep growing. The whole idea doesn't work without it, and GDP is a part of that. So they seem to go hand in hand in the current system under which we all live and operate. But do we have any more? Who else said what?
We have plenty more. Next one is referring to Giannis. Beloved Giannis. Varoufakis thinks he's going to get something out of the EU by insulting its members. Bullying isn't a good strategy unless you're bigger and stronger. Apparently, he ran out of ideas.
He didn't run out of clothing ideas. He's been looking great. No,
Actually,
he's been looking great.
That they were talking about that he in Germany apparently he's an idol. You know, he's like a sex symbol there. You know, like David Hasselhoff or something like that.
Yeah, they love Hasselhoff in Germany.
Right.
I mean, Varoufakis for a finance minister, he is handsome. Yeah, I mean, he's handsome anyway, but seriously, for a finance minister, he's up. But this has nothing to do with this, the comments. So yeah, maybe he's if you're that good looking, you can't. No, we're joking. The whole idea is that, I mean, I don't know if he's bullying. That's how he's always been. You know what I mean? I don't think this is bullying. I think it's just shocking when you hear someone who's in that position not mince words. You know, just say it how it is. It seems like, oh my goodness, what a in your face. Oh, they're always like that. Can you really call it bullying? I don't know. What are your thoughts, Ed?
You can't bully when you are the minnow and you're going against you know, this giant. Basically, he's saying we're bankrupt, but we're not going to. We're basically going to default if we don't get some sort of equitable agreement. And I think we can get one. That's the message I'm hearing.
Yeah, I would agree. Any more?
Oh, yes. All right, this is in reference to the big deal yesterday about smartphones and the future of computers. There was a time when digital watches contained calculators, but everything got too small. I like a big screen and don't like charging my phone every day, so I cannot see a transition to smartphones. In fact, I see the PC becoming the TV.
Here's my case on that is that really it's the device doesn't really make a difference as long as it has enough computing power. I think Kevin, who's our director, he was saying to us before, but you know, look, I need to do these whiz-bang things on my computer, but for most people, they don't have to do whiz-bang things. As long as it has enough power, all you really need to do is have that little device and then have the big screen in some way connected to it, tethered to it, and you know, a keyboard and a mouse, and that's it. Really, that's what you need. I think that's where we're going.
I would agree with that. And actually, I think someone commented underneath this comment that said there's going to be self-charging, you know, devices soon, and that's another thing to think about. You know, it's not going to run out. And I still say that. I can't believe books can run out of batteries. Like, that blows my mind. So I'm not an early adopter of any of this, but I do think that it will get there eventually. You guys, this is always so much fun. I wish that we could do it every day, but we could just collect them at once. So thank you. That's all the time we have for now. But we love hearing from you, obviously. We love discussing it on the show, so please continue. Check out Facebook and also check out YouTube. Our Facebook page is facebook.com/BoombustRT, youtube.com/BoombustRT as well. And you can also tweet at us at Aaron8, at EdwardNH, at Bianca Fascini.
Yes,
there you go. You have it from all of us. From all of us here at Boom Bust, thank you so much for watching. We'll see you next time. Bye-bye.